Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly newsletter. Today's date is April 29th. Let's dive into the week's stock market news. European stocks rise on easing tensions and earnings. Bond yields climb. European stocks rebounded strongly on date, snapping a 3-week losing streak. The Pan-European Stocks Europe 600 index closed 1.74% higher, fueled by a combination of positive factors. Easing tensions and encouraging earnings lift sentiment. Investor sentiment improved after tensions in the Middle East eased, reducing some geopolitical uncertainty. Additionally, positive corporate earnings reports from various companies helped to boost confidence in the market. Major stock indexes across Europe participated in the rally. Germany's DAX gained 2.39%. France's CAC 40 index added 0.82%. and Italy's FTSE MIB climbed 0.97%. The UK market reaches new heights. The UK's FTSE 100 index outperformed its European counterparts, reaching a fresh all-time high with a gain of 3.09%. This achievement highlights the relative strength of the UK market compared to others in Europe. Rising bond yields reflect global interest rate concerns. Despite the positive performance in stocks, European government bond yields hit their highest levels of the year. This increase is likely connected to strong economic data released in the United States. The data raised expectations that the Federal Reserve will keep interest rates higher for a longer period. This, in turn, could prompt other major central banks, including the European Central Bank, ECB, to follow suit with their own interest rate hikes. The yield on the benchmark 10-year German government bond, a key indicator of borrowing costs, briefly surpassed 2.6%. ECB officials express caution on future rate cuts. While numerous ECB policymakers have signaled their intention to lower interest rates in June, provided no major economic shocks occur, some comments from more hawkish members within the bank cast doubt on the likelihood of further reductions after that initial move. Joachim Nagel, president of the German Bundesbank, cautioned in a speech that a potential rate cut in June would not necessarily be followed by a series of rate cuts due to the current economic uncertainties. Executive Board member Isabel Schnabel highlighted that services inflation is a major concern. She stated, "There is a consensus emerging that we may be facing a quite bumpy last mile in terms of achieving price stability." These comments suggest that the ECB's monetary policy path might be more cautious than some market participants anticipate. Positive signs for the Eurozone economy. Despite the concerns about inflation and interest rates, there were some positive developments on the Eurozone economic front. Business activity picks up. Business activity in the Eurozone grew at its fastest pace in nearly a year in April, driven by a resurgence in the services sector. Purchasing Managers surveys compiled by S&P Global revealed a first estimate of the CHICOB Eurozone Composite Purchasing Managers Index, PMI, at 51.4, up from 50.3 in March. This indicates expansion in the private sector. German downturn may be bottoming out. Germany's PMI and the IFO Institute's Business Confidence Barometer provided further evidence that the country's economic downturn might be nearing an end. The German private sector returned to growth in April, with services activity increasing and a decline in manufacturing easing. Overall business sentiment improved for the third consecutive month, and the German government increased its forecast for economic growth this year to 0.3% from the previously projected 0.2%. UK economy growth but weakening demand. The UK also saw its business activity strengthen in April, with the composite PMI rising to 54.0 from 52.8 in March. However, a potential cause for concern emerged. Input costs increased at their strongest pace in 11 months, while output prices declined. This suggests that weakening demand could be putting pressure on business profit margins. Overall, the European market experienced a positive turnaround, easing geopolitical tensions, encouraging corporate earnings, and signs of economic resilience in the Eurozone all contributed to the rally. However, rising bond yields and cautious comments from some ECB policymakers regarding future rate cuts highlight the ongoing uncertainties surrounding inflation and monetary policy. The UK market also showed signs of growth, but potential issues with weakening demand require further monitoring. Now our insight into alternative markets. Private debt secondary market poised for boom in 2024. Survey predicts surge in deals and pricing. The private debt secondary market, where existing private debt investments are bought and sold, is on the cusp of a significant expansion in 2024, according to a new survey by Ely Place Partners, an advisory firm specializing in private debt. Their findings, based on a survey of specialist investors, paint a picture of a market brimming with opportunity for both buyers and sellers. Key takeaways from the Ely Place Partners Private Debt Secondary Market Survey 2024. Explosive growth. Deal volume is projected to skyrocket by 50% to 100% compared to 2023, with a potential range of $10 billion to $15 billion in closed transactions. This surge reflects a confluence of factors, including a growing pool of capital from institutional investors seeking access to the private debt asset class. Quality on the rise. The survey anticipates an improvement in the overall quality of deals available in the secondary market. This translates to a wider range of pricing options, with particularly strong demand for high-quality senior loans potentially pushing their prices closer to their face value. Increased competition. The influx of new capital is expected to fuel heightened competition among buyers, potentially leading to an overall rise in pricing for private debt assets. This competitive landscape, however, is viewed positively, as it indicates a healthy and maturing market. Shifting sellers. The survey predicts a rise in both LP-driven, limited partner, and GP-driven, general partner, transactions. However, LP-led deals are expected to dominate, with pension funds likely to be the biggest category of sellers looking to offload existing private debt holdings. This trend reflects a growing comfort level among LPs with utilizing the secondary market to manage their portfolios. Expert insights. Commenting on the survey results, Daniel Roddick, founder of Ely Place Partners, stated, "The past year has witnessed a steady increase in the size and number of private debt secondary market deals. The emergence of a dedicated group of buyers has instilled confidence in LPs, enabling them to bring larger portfolios to market. At the same time, GPS, general partners of private debt funds, are increasingly taking advantage of the secondary market to expedite liquidity for their investors." The road ahead. The findings of the Ely Place Partners survey paint an optimistic picture for the private debt secondary market in 2024, with a projected surge in deal volume, quality, and competition. the market appears poised to solidify its position as a valuable tool for both investors seeking to enter the private debt space and existing participants looking to manage their portfolios. As the year unfolds, it will be interesting to see how these predictions translate into real-world market activity and whether the anticipated growth materializes as expected.
Thank you for listening to this episode of Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, thubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.